Welcome back to Talk Tickers. This is the deep dive where we listen to the earnings call so you don't have to. We cut through the corporate jargon to get to what really matters.
And today we are tackling a big one, HDFC Bank, the second largest lender in India.
We are, and it's under some pretty unusual circumstances.
It is. We're recording this on a Saturday evening, January 17th, 2026. The call just wrapped up in Mumbai.
Which means the markets are closed, the NYSE is shut for the weekend, and then Monday is the MLK holiday.
Right. So there's no price reaction. We're not trying to explain a 5% pop or a 5% drop.
Which is actually kind of great. It lets us look at the pure fundamentals, the actual machinery of the business without any of the market noise.
Exactly. And for HDFC, ticker HDB, that machinery is, well, it's fascinating right now. They're in the middle of this whole post-merger funding story.
That's really the core of it, isn't it? The big question going into this call was all about their funding. Can they get enough deposits?
And can they do it without, completely crushing their margins? That's the multi-billion-dollar question.
So what was the tone from management?
I'd call it reasonably sanguine. They're not panicking, but they made it very clear that they're on a bit of a diet when it comes to loan growth.
A diet.
Yeah.
I like that. Okay, before we get into that strategy, let's just run through the headline numbers for everyone. This is Q3 FY26.
Sure. Quick snapshot. For the ADR, the American Depository Receipt, they reported earnings per share of 40 cents.
And consensus was what, 39 cents?
Yeah, 39 cents. So a penny beat, a solid start.
Okay, a penny beat is good, but the revenue line, I'm seeing $5.06 billion, which looks like a small miss.
It was a slight miss, yeah, by about 13 million. But with banks, it's always a bit different. If you look at the standalone numbers, the Indian numbers, net profit was up 11.5% year over year.
So double-digit profit growth. That's still a very healthy engine.
For sure. And net interest income, that's their core bread and butter, was up 6.4%. So cash is being generated.
But honestly, digging through the materials, I don't think anyone really cares about the profit number this quarter.
No. All eyes are on one single number.
The elephant in the room.
The credit deposit ratio.
It's the CD ratio. And it's sitting at, what, around 99%?
Just about 99%.
I mean, help me out here, but running a bank at 99%, that feels like driving a car where the gas light's been blinking for the last hour.
That's a perfect analogy. It means for every dollar or rupee they have in deposits, they've loaned out 99 cents. There's no buffer.
So they're basically constrained. They can't grow loans any faster than deposits because they literally run out of money to lend.
They're at the red line. And management was very upfront about this, which I appreciated. They have a glide path, they called it, to get that ratio down to around 90%.
A glide path. So that means slowing down.
Yeah.
Usually calls are all about growth, growth, growth.
And this is the opposite. It's we need to fix the plumbing first. They said they'll grow loans in line with the system this year, maybe 12, 13%, and then try to accelerate in FY27.
Okay, but this is the part that twists my brain a little. If you're that desperate for deposits, why not just, pay for them? Jack up the interest rates on savings accounts.
That's the normal playbook, right? But they're refusing to do it. They showed incredible rate discipline. In fact, their cost of funds actually decreased this quarter.
Wait, hold on. It went down by how much?
By about 10 to 11 basis points.
So they need money, but they're paying less for it. How on earth does that work?
Well, a couple of things. One, the whole system is helping. The Reserve Bank of India has been cutting rates, so that helps everyone.
Okay, a rising tide.
But two, they made a tactical choice. They walked away from expensive institutional bulk deposits. They just said no to that money.
So they let that business go.
They did. They let it grow in the mid-single digits. Instead, they're chasing what they call granular retail deposits.
Ah, the CSA. Current account savings account. The sticky, low-cost stuff.
Exactly. Our checking accounts that earn basically nothing, that's the holy grail. And that part of the business is growing double digits. It protects their margins, which is why their net interest margin actually ticked up to 3.35%.
Okay, so profitability over vanity growth. That makes sense. Yeah. But it also means you have to work a lot harder. You can't just wish for millions of retail customers to show up.
And this is where the call got really, really interesting for me. The nerd out moment.
The branch vintage math. Yes. Let's unpack this, because I think this is the absolute core of their entire long-term story.
It really is. They basically laid out the compounding magic of a physical bank branch.
So you build a branch, it's a box. You pay rent, you pay for staff. How long until it actually makes money?
Their data says a metro branch breaks even in 22 months. A rural one takes a little longer, maybe 27 months.
That's a long time to carry a loss-making operation.
It's an investment phase. But this is where the magic happens. After 5 to 10 years, that same branch grows its business volume by 3x.
3 times? Okay, that's pretty good.
But then you get to the 10 to 15-year vintage. Those branches, they grow 10x.
10 times the business.
Yeah.
Just by being there for a decade.
10 times. It's about community trust, generational accounts, all that stuff. And here's the real kicker.
Go on.
43% of their entire branch network is young. It's under 5 years old.
So they have this massive wave of branches that are just about to hit that explosive growth phase.
Precisely. They have 12,232 branches that are just entering that 5 to 10-year window. The money has been spent. The costs have been sunk. Now, mathematically, they should start harvesting.
Get the lag effect. The seeds they planted years ago are about to sprout.
That's the theory. But they're not just waiting around. The hiring numbers were, honestly, they were staggering.
I saw that. They're adding, what, 500 new branches?
That's standard. But the people, they're hiring 7,000 bankers.
Wow.
And get this, 30,000 support staff.
30,000. That's the population of a small town. What are all those people going to do?
They're the boots on the ground. They're the army that's going to go out and gather all those retail deposits to fix that 99 per CD/BED ratio. It's a huge investment in just pure distribution capacity.
It is. But that's also a massive amount of new salaries on the payroll. So the execution risk is huge. They better hope that vintage math plays out.
It's all about execution, but at least they're doing it in what one analyst called a Cinderella phase for Indian banking.
A Cinderella phase. What does that mean? The pumpkin is a carriage and the clock's not midnight yet.
Pretty much. Gross non-performing assets are super stable at 1.24%. Provisions are down. People are paying their bills.
I did see a little note about some trouble with agricultural loans, though. A compliance thing.
Yeah, that came up in the Q&A. The central bank flagged an issue. HDFC took a provision of about 5 billion rupees.
5 billion sounds like a lot.
It is, in absolute terms. But they ate it, they absorbed it completely within the quarter's results and still beat on profit. It shows how resilient their earnings power is.
The fortress balance sheet in action. Okay, let's pivot to products, how they lend the money. Auto loans and credit cards really stood out to me.
Yeah, the auto loan stat was great. They said 80% of their auto loans are self-funded.
Which means?
The person borrowing the money for the car also has a deposit account at the bank.
That's genius. So if I default on my car loan, you can just dip into my savings account.
Well, not exactly that simple, but effectively, yes. It makes it incredibly low-risk lending.
Smart. And then credit cards. This was fascinating. They're not chasing the high-interest debt guys anymore.
No, a complete pivot. They explicitly said they don't want revolvers, people carrying balances month to month. Their revolver levels are way down, less than 2/3 of what they were pre-2020.
But isn't that where banks make all their money? The 25% APR.
It is, but it's also where all the risk is.
Yeah.
They see the card differently now. For them, it's an enabler for liabilities.
So the card is the bait.
Exactly. Their data shows a cardholder keeps 5.5 times more money on deposit than a non-card holder. So they use the card to get your salary account, and that's the real prize.
It's a transactor model, not a lender model. They want you to swipe, pay it off, and keep your life savings with them.
You've got it. It all feeds back into solving that main problem, the need for deposits.
So let's tie this all together for someone listening. If you own HDFC, what's the story you're buying into now?
The story's rotating. It's moving away from post-merger indigestion, which was messy and painful.
Right.
And it's rotating to operational unwind. The merger's done. Now it's just about engineering the balance sheet and executing on distribution.
It's pure execution risk. The catalysts to watch are simple then.
Very simple. First, can they grow deposits faster than loans to get that CD ratio down? That's the scoreboard.
And second,
Does that army of 37,000 new hires actually bring in cheap deposits, or do they just become a massive overhead expense?
and the market is clearly in show-me mode. The stock's been weak.
Down about 7.5% in the last month. The market wants proof, not just promises.
All right, so since there's no price reaction to guide us, we have to move on to our favorite segment.
Ah, yes. Time to get a little weird.
It's time for This Is Not Financial Advice.
The obligatory disclaimer. This is absolutely 100% not financial advice. This is purely for entertainment. Do not sue us.
Okay, what have you got for me?
I'm calling this one the human capital carry trade.
Ooh, intriguing. Explain.
Look at those hiring numbers again. 37,000 new employees. That's a small army.
It is.
And what does that army need? They need office chairs, they need desks, they need uniforms and chai and places to live near all these new branches they're opening.
So you're not buying the bank.
No, the bank is constrained. You buy the suppliers to the bank. The trade is to go long commercial real estate developers in Tier 2 and 3 Indian cities, or by the Indian office furniture manufacturer.
You're playing the picks and shovels, HDFC is spending the money, and you're just trying to figure out who's catching it.
That's the play. They open 500 branches. Someone's got to sell them the furniture.
I love it. Okay, my turn. I'm calling this short the revolver, long the swipe.
Yep.
It's based on that credit card data. HDFC said people are paying off their balances, the revolver rate is down. But card spend, the actual transaction volume, is up 15% year over year.
So people are swiping more, but borrowing less.
Exactly. So who wins? Not the lenders who depend on high-interest debt. You short them. You go long the payment processors. The gateways that take a tiny sliver of every single swipe.
They get paid on volume, not on debt.
They get paid whether you pay your bill or not. It's a pure play on the velocity of money.
That's a sharp one. I like that. The velocity of money is up, but the stickiness of debt is down.
There you have it. Two absolutely terrible trade ideas to mull over.
Please, do not trade based on our office furniture thesis.
All right, let's bring it home. HDFC, solid profit beat, expanding margins, but on a strict loan growth diet until deposits catch up.
The engine is working, it just needs more fuel. The whole story for the next year is whether that branch of vintage math actually works in the real world.
And that really leaves us with one final question for you to think about. That 10x multiplier on a 10-year-old branch, that's based on historical data.
In a pre-digital world, mostly.
Right. So does a physical branch still age like a fine wine in 2026? Or has digital banking completely disrupted that vintage curve before it gets a chance to mature?
Is it a law of physics or a relic of a bygone era?
If everyone is banking on their phone, does that 10-year-old branch even matter anymore?
That is the big unknown.
Something to think about. As always, do your own due diligence.
Talk tickers out.
Catch you on Tuesday when the market's open.